Want to retire, but still paying for your kids' college? Learn today from the college dude how you could potentially cut the payment in half.
Hello and welcome to the Relax It's Retirement podcast with your host Josh Leonard, where we talk about transitioning into retirement with intent. I'm Wendy McConnell. Josh, how you doing, man?
Good. How are you today, Wendy?
I'm good. You're just full of hijinks and shenanigans today, I've got to say.
Yes, absolutely. Got to have fun. It's Monday when we do these recordings, so we got to have fun with it, right?
Yeah, I'm having a blast. Can't you tell?
Well, you know what's even more fun?
Yes.
College debt and college borrowing.
Oh, yeah, that sounds like a lot of fun.
Yeah, yeah. So we brought the college dude back on LinkedIn. I saw Dan recently passed his CSLP, which is Certified Student Loan Professional designation. So I thought I'd have him back on to talk about some great ways to manage student debt.
Yeah. Well, thank you for having me, Josh. Really, it's great to be back, and it's great to see your podcast doing great things too. But yeah, super excited about today.
Dan, do you have a last name?
Cieniewicz, yes. I'm not
Okay.
going to put you in the task to spell it, but yeah,
I just
it's
thought it would be nice if Josh actually introduced
It-
you as,
it-
more than a Dan.
but see, Sinowitz is better pronounced by Dan than me saying Sinowitz and
Yeah,
him being offended by my mispronunciation. So thanks for calling me out, Wendy.
he's always blameless, isn't he, Dan? Always.
I'm getting that. I'm getting that sense here. Yeah, yeah.
So, Josh, what are we gonna let's dive right in.
Yeah. I think Dan and I were talking recently about student debt and, student loans. And, one of the biggest hurdles that we see folks preparing for retirement having is, you know, I want to save more for retirement, but my kids are also entering school. So I want them to have a good education and get a good jump start in life. But many times that can lead to mom and dad not saving enough for retirement or incurring debt. So Dan and I were talking about Parent Plus loans in particular. So Dan, can you tell us a little bit more about Parent Plus loans?
For sure. Yeah. So, for those that don't know or aren't really familiar with the student loan landscape, there are a number of different types of student loans out there. Oftentimes, they're lumped together. But Josh, the question that you bring up, what are Parent Plus loans? Parent Plus loans are loans that are taken out in the parent's name only, but they're designated for the child who is going to achieve an undergrad education. So, parents can take out these types of loans, Parent Plus loans, directly through the federal government, and then they end up again utilizing those to pay for a child's undergrad education. So it'd be anything the first 4 years prior to any type of grad school, law school, med school. So it's utilized by a number of parents that are looking to help fund it, and maybe don't have the savings, or they don't want to see the kids take out loans in their names via private loans, or going down the path of paying for it outside of that.
Okay. And, much like the accountability I have for pronouncing your last name and sending Wendy my show notes ahead of time, I think one of the things that we had talked about is those Parent Plus loans. The criteria for loan underwriting is pretty
Mm.
low, right?
That's exactly right. I think for anybody that's applied for any type of loan, car loan, mortgage, even private student loans, bank underwriting takes place, and that usually it's a process, and rightfully so. The reason why the bank wants to require that type of underwriting is because they want to know that they're taking on a risk uh, on the borrower end, that they're going to pay that money back, or there's a high probability that they pay that money back. But Parent Plus loans are actually they're basically backed by the federal government. So the federal government, as we know, sometimes they try to be favorable, I think, when offering terms when it comes to loans that can end up being repaid properly. So the credit check is not nearly what it would be for somebody that's actually applying for, like I said, the traditional types of loans. So you can find all of the types of criteria that are required on the Department of Education website, but let's just say that the underwriting process is a lot less rigid than it would be for somebody that's applying for any other type of debt.
Yeah, so I think a thing we commonly see is, parents take out those loans, right? They want their kids to get the education they want. They want to go to a specific school.
Hmm.
So great, we're only going to get this much money. Now we have this Parent Plus option. So we'll fill in the gap with that. Is that what you see a lot too?
Yeah, definitely. And I think it's something that is sometimes it can be part of a great strategy. Other times it can be part of a losing strategy. Quite honestly, the last thing that we want to see anybody have to incur is debt that they can never get back from underneath from. So we really want to try to do our best when we're advising folks that if you're going to be taking out Parent Plus loans, that you make sure you have a strategy to repay. Believe it or not, people have other goals other than just sending their kids to college, such as retiring one day.
Yeah.
And if you do it, improperly, then you may be subject to a delayed retirement or retirement that doesn't look like maybe what you had envisioned. And it's something that we really are hyper sensitive to make sure that if people are going to be taking out Parent Plus loans, that they know what the repayment options are, and then even some things like forgiveness or discharge if necessary. But at a minimum, we want to make sure that people are able to achieve their types of goals, but do so in a way that they're aware of.
Okay. Yeah, I know when we had talked the last time you were on the podcast, we talked more on the front end of college planning, right?
Correct.
So what can we do to prepare and I've talked about on here a lot about grandparents
Hmm.
helping out. Maybe it's that grandparent 529, gifting your grandchildren college money, rather than a plastic toy that they're going to forget about in 6 months. But you had said something when we were talking recently, referring to liposuction. So I'm going to toss that one back to you.
Yeah, yeah, it's an expression that, I think it's an unfortunate expression, but one I'll share nonetheless. It's, rather than people wanting to do the diet and exercise, people would prefer to have liposuction. And that's kind of something that takes place in the student loan landscape where listen, it's hard. It's hard work to prepare for college. But folks would rather, I shouldn't say they would rather, but oftentimes they find themselves in the unfortunate situation of having too much debt, and they say, "Well, what can I do now?" As opposed to doing the work up front to make sure that they're able to go and budget properly for college. But yeah, it's kind of a, like I said, an unfortunate term, but one that we've seen quite a bit of with when it comes to repaying student loan debt and Parent Plus loan debt in particular.
Yeah. I mean, I think it's true in many aspects of our lives, right? We'd rather fix the problem once it is a problem.
Exactly.
Um, Now, if you're sitting down with a couple and let's say that their kids are out of school and they
Mhm.
have maybe a combination of debt, what's like the first step to try to get a hold on the debt that you have and hopefully better manage it?
Yeah, that's the million-dollar question. I think it is just making sure that there's an understanding, especially if their Parent Plus loan, if the Parent Plus loan, if the parents have these plus loans, technically speaking, they're the ones that are required to repay. So the child really has no legal obligation to repay. It's all on the parents when it comes to their actual, if it's going to affect their credit or not. So the first thing is making sure that there's a game plan, and we try to do our best to make sure that the child is actively involved in that game plan. So that's really the first thing, is to make sure that they understand that this is debt that the parent took out for the child, but it obviously really was it was for the child's benefit. So assuming that that's kind of the groundwork that you're working with, what we then want to find out is what are the options then to repay. And a couple things that really that go into account on this are going to be the types of income driven repayment plans that are available for Parent Plus loans, and that, which is one of the differences of student loan debt compared to a mortgage or compared to a car loan, is depending on the tax return that was previously filed and the type of income that the borrowers are making, that can actually lower a student loan payment. And then you look at that, you look at other criteria of whose loan the actual name is in. It's usually not in both parents' name, but rather in one parent's name. And then these types of factors, then, if you're looking at this, in addition to tax planning, retirement planning, these are all the different things that we can look at and say, well, based on all these factors, we can then come up with more of a plan to say this is how much you can be expected to repay. And depending on the type of income driven repayment plan that they're in, year to year, there's usually some homework that you have to do and some upkeep with it to make sure that the actual repayment that's taking place is going to continue to get to the goals of where these folks want to be.
Yeah, I think it's interesting because many times when we're budgeting with a client preparing for retirement and we see student debt on there, it comes in two forms. One in that Parent Plus loan, or maybe
Mhm.
it is in the student's name or in their child's name, but they're helping to pay for it. And my
Correct.
go-to recommendation almost always is, when's your kid going to get a job, right? Like, when
Yeah.
are they going to be in a position? And if they're finishing their residency or something of that nature, where
Mhm.
in a short period of time, they should be making more than enough to be able to help satisfy this debt, then great, let's factor that into a plan. What scares me is someone that wants to retire in 2 years and $1,000 of their monthly budget is, going to student debt. That is sort of, for many folks, that was a lot more than their first mortgage, and
Mm.
now they're paying that as a debt obligation in retirement, which is less than ideal. Um, I think we had talked about the Parent Plus loans, and what is the technical? It's like a double, triple backflip, something.
Yeah, that's the terminology. It's the double consolidation loophole that I think you're referring to.
Okay,
Um,
yeah, that's
yeah,
it. That's it.
yeah. So it's one of the best strategies I think when it comes to repaying a Parent Plus loan. Certainly not applicable to everybody, as no advice should be. But um, I think what we sometimes find when it comes to student loan repayments again is there are all these great options that are out there, but what people don't always understand is Parent Plus loans have a lot of similarities to some of the federal loans, but there's also some differences. So one of the big differences is that when you consolidate a loan, and this goes for student graduates, maybe that come out, doctors who may have hundreds of thousands of student loan debt, if they're a part of the federal loan system or their federal loans that they have to repay, they can get onto an income driven repayment plan. And as a result, they never have to worry about having these astronomical student loan repayments. Just because their first couple of years, if they're in residency, they don't have to they may not be making what they're going to be making in a couple of years. But for parents, they don't have that option directly. There's only one type of income driven repayment plan that they're eligible for, and it's the least favorable option. It's called the income contingent repayment plan. So it's something that I think for a lot of parents, they may look at and say, well, my best option isn't a very good one. But that's where this double consolidation loophole comes into play. It's an option that's available, that you can get into any of the income driven repayment plans. There's some legwork involved to it, but it allows you to get into any one of those income driven repayment plans and allows you to potentially be paying a lot less than you would be on just that the income contingent repayment plan, or just on the general standard repayment.
Yeah, so I think for someone, if you're transitioning into retirement, maybe you're going from a fairly high paid position and you were able to save money, but now in retirement, your income is going to be lower, like it is for most folks. That would be a good way to potentially reduce that debt obligation for you.
Absolutely. I think that's where the planning really comes into play. And I think what a lot of people may not always realize is, once they transition into retirement, typically retirement income is going to be taxed differently than earned income is. So as a result, depending on the different types of retirement income that's out there, that could, lower the monthly payment that you have to repay, specifically if you're on one of those income driven repayment plans. So that's really where I think the focus has to be for parents, is to understand. And you mentioned it, like $1,000 repayment. That's not an uncommon repayment, unfortunately, that a lot of parents see. And that will affect the bottom line in retirement. We care about our net income in retirement, but our cash flow, I should say. And if you have $1,000 going out,
Yeah.
that's going to affect it's going to affect your standard of living. So to lower that repayment, that's usually what we want to try to focus on and work towards accomplishing. But just like you said, Josh, that's really the way to do it, is to understand, okay, as we transition to retirement, we might be in a lower income environment when it comes to what we're taking. And as a result, that means that the student loan repayments, assuming it's that Parent Plus loan as part of the federal system, could really be lowered drastically.
Yeah. So let's say that we're trying to reduce that monthly payment. How frequently is your income reassessed, or do you have to declare that every year? How does that work on sort of the maintenance side, right? Because
Y-
we could retire, take all of our money out of savings for 1 year and say, well, we don't have any income coming in.
Yeah, and you're exactly right. I think that's where it's a year to year thing. So to answer the
Okay.
first question, it is an annual recertification that you have to do of your income, but that's where I think again you just mentioned that savings are an example of something that the way that the savings are taxed if you're using that as income is a lot different than if it's earned income or if it's coming from a pre-tax account like a traditional IRA or traditional 401k. But that's where a lot of the combination of ways in which you can take income in retirement if you have assets like Roth assets or things that
Mhm.
are after tax. That's something that really can again lower that monthly repayment on your student loan repayments, just because they're going to look at your adjusted gross income, your AGI, what's going to hit the tax return. So if you don't have
Mhm.
income hitting the tax return, the Department of Education is going to look at that and say, well, this person could have a $0 repayment, or it could be obviously a lot lower. It's not going to be a $0 repayment in every circumstance, but there definitely are some ways that you can look to lower that repayment. So there's relief out there for Parent Plus loan borrowers. It's just understanding, again, you don't want to cut off your nose to spite your face. Don't make some of these moves just so you have a $0 repayment. You also
Right,
want to
right.
be cognizant of the tax planning and other making sure that this money lasts for the long term.
Yeah, in our monthly video series that we release on YouTube, I recently did a bit of the video covering Roth conversions, where
Mm,
saving in taxes is great. But for most folks we work with, having more money is actually more important. So,
mhm,
you know, if you can get more compounding power with a taxable asset by not taking, you know, a Roth conversion in a huge tax bracket,
mhm,
um, it
mhm,
can benefit you in the long term. So, as we talk through these kind of things, by no means, listeners, don't take this as a
mm.
recommendation to, you know, do a Roth conversion on all your money so you don't have to pay back your kid's student debt. That
Right.
certainly is not recommended, but a balance of these things. And we talk about that tax diversification a lot, where it might make sense to have that brokerage account, some money in savings, the Roth IRA, your traditional, so that you have some optionality. And maybe as part of your retirement income plan, if paying down student debt at a lower rate comes into play, maybe that alters the income plan so we can keep that AGI level, or that AGI more level throughout
Mhm.
retirement.
Yeah, that's really well said. I think that's to me, again, this is all part of a strategy. So for some folks, they may have a mountain of Parent Plus loan
Mhm.
debt, and in order to lower their monthly payment, they may need to take more drastic measures to do that. But as we both would agree, we don't want to be making these moves simply without considering all other factors, because that's where I think people can oftentimes find themselves in a little bit of trouble as they go to the extent of something that sounds like a great it sounds great on paper, but when you actually pop up the hood and look at all the different changes that are taking place, it's not going to be a one size fits all recommendation. But there are people I think that can find themselves in that position where maybe if there's a situation where they can look to apply for some level of forgiveness, whether that be through the public service loan forgiveness or the standard forgiveness that exists with some of these Parent Plus loans. That's a way that, again, it might make more sense for people to take some other considerations than it would if they aren't going to apply for that forgiveness. So, yeah, it's not a one size fits all answer.
Yeah, let's talk about that public service bit again too, because
Hmm.
when we were talking in our preparation call, you had discussed how if it's a Parent Plus loan, it's the parent working for the government, not for,
Yes,
public service, I guess, not
correct.
necessarily the government, but
Yeah, yeah. It's a common misconception, and it's one that it kind of goes back to what we were talking about though in our previous podcast interview. I think that's where for folks that may be considering Parent Plus loans, you can take advantage of the public service loan forgiveness if, just like you said, Josh, the parent is the one who has the public service job. So if the parent has that public service job, or they're working that would qualify for public service loan forgiveness and a job that would allow them to do so, they should be giving consideration to just having that loan in their name. So what we often see is maybe there's one parent who has a private sector job that might be paying more than the parent who's earning maybe less in a public sector job. And if that's the case, again, I'm not going to give a blanket recommendation, but for the purposes of public service loan forgiveness, it's almost always recommended that we consider having the Parent Plus loan taken out in the loan. I'm sorry, the name of the person working in the public sector job, just for that reason. So it's a 10-year schedule that they're subject to repay, and that could then lead to obviously being able to fund education in a much more efficient way than they would have been able to otherwise.
Yeah, yeah, I think that's very interesting, and certainly, I think it's a good balance in society too, from a higher level. That if maybe you are in a lower paying job because you're doing some sort of government work, right?
Hmm. Yeah.
Maybe it helps out with college a little bit too. Um,
Yeah. Yeah.
so I,
For
I
sure.
think keep in mind, listeners, these are all things that were built into a law. However confusing it all seems for a reason, right? So whatever
Mm.
your situation is, make sure you're meeting with someone that can help address all these nuances to make sure you're making the most out of your financial situation.
Yeah, definitely. And like you said, it's just, I mean, just as you brought up in some of the points here, there's many factors to consider, but I think the biggest takeaway that I've had, I mean, just studying with the course, but also with working with families, is there is relief that's out there. I think we oftentimes think that there's just, you got to repay this, and to some extent you do. I'm not saying you just don't repay your loans, but at the same token, I think that the federal government has kind of established the rules that can allow for a strategies that can be put into place to do their best to help borrowers who have gotten themselves in too deep of a hole. But it does require education and work. I mean, there's just no other way to say it. It's a process.
Yeah, I think one of the other things that you brought up too, when we were talking last week was, if you, let's say that you restructure your Parent Plus loans and now you have a lower payment, maybe that lower payment isn't really paying down the debt very quickly.
Hmm. Hmm.
I think, to me, one of the fears that would come into play is, okay, well, is that debt going to get passed on to my kids? So what happens in that scenario?
It's a great question, and that's one that I think is, it depends is currently the answer, but as the rule states right now, for Parent Plus loans, if, and again, not to get grim on this call here, but if the parent passes away or becomes permanently disabled, or if the child were to pass away, who's the Parent Plus loans, the name, or the Parent Plus loan who took the for the child, if one of those individuals passes away, the Parent Plus loan debt is discharged. So it does create, I think, again, I don't mean to sound grim when I say that, but there's some hope in that it won't at least pass on to the child in that case. But the current rules, at least until the end of 2025, state that that is currently tax free. If that discharge, it's a tax free event. But if the Tax Cuts and Jobs Act of 2017, if it does sunset, which it's currently scheduled to do at the end of 2025, that would be a taxable event. So just to give a quick, example, if my parents had a Parent Plus loan of $100,000, and the individual, one of my parents who took the loan out, if they had passed away, that $100,000 before the end of 2025 would be a tax-free event, and I wouldn't have to worry about anything on the repayment. But if it's after 2025 that the parent passes and they pass it along to the child, that would show on the estate tax, and that could be something that could create a taxable event, depending on the size of the debt and whatnot. So something to consider. I think it's something that it's something to keep an eye on, and we'll see if Congress takes any action towards that. We don't know, but I know it's something that, as that Tax Cuts and Jobs Act looks to sunset, I think it's something that's going to be debated in Congress.
Yeah. Yeah, I think certainly the landscape of retirement over the last, I guess 6 years now has been changing so quickly,
Mm,
um with all these legal updates. I mean, many things, even like an RMD that forever was age 70 and a half, then was 72, now it's 73. If you're
yep.
younger, well, it's going to be later. All of these things changing. I think now more than ever it's important to have someone that specializes in this arena, So when I saw that you got an additional designation, I'm glad to hear that you're still learning and focused in this college planning, whether it's on the front end or back end
Yep.
of the college experience. Because I think for advisors like myself that are more focused on retirement, well, this can come into play in retirement. So having people that specialize in certain areas is one of the key factors in a successful practice for us, and I'm sure it is for you too.
Absolutely, and you hit the nail on the head there. It's I do think there's a specialization that needs to take place amongst advisors just because with all the changes that are taking place, you just mentioned it, in the last 6 years in the retirement alone, I mean, the number of changes is substantial, and that's even just at the federal level. It's not saying that there aren't changes that take place at each state level. So, for student loan debt, that's no different. I think the if you've been following the headlines, you're seeing forgiveness one day, you're seeing
Yeah.
it's taken away the next. So it really becomes it's a fluid situation, and the best that we can do as advisors is plan for what's in front of us, but also keep an eye out for what's on the horizon. Just like you
Mhm.
mentioned with retirement, it may not be exactly how it's currently stated today, but we do have to plan for that if it does stay the same. So that's where I think the understanding of each what each nuance is into in terms of the different types of areas of planning that we have to do our best to plan for that and advise folks accordingly.
Yeah, I think I'm constantly reminded through situations with clients too that tax diversification or different ways that we can
Mm,
access funds throughout life
yes.
is so important. I mean, many folks we've talked to for years about, oh, maybe do a little bit of Roth conversion. Well, I don't know. I don't know that that'll ever help me. Well, when the water heater breaks, the car breaks down, and the roof starts leaking all at the same time,
Hmm.
and you've really maxed out that tax bracket, it'd be awfully nice to have a tax-free bucket to withdraw from.
Hmm. Yeah.
You know, I think this in looking at that student loan repayment, the income options, maybe even just ways to help pay for college ahead of time,
Mm.
maybe prior to retirement, having that tax diversification is certainly key in these scenarios as well.
Yeah, again, I think that is again one of the biggest takeaways that I had from the course. But even just in working with clients, it's exactly that. And again, you alluded to it earlier in the conversation, but it's 100% true. Like no two clients are going to be the same, and I think that's where this really does come back to just because your neighbor does something or somebody kind of saw this on the news or this that I'm always leery to just say make every single recommendation blanket or universal
Sure.
because the double consolidation loophole could be great for one family, and it may not make any sense at all for another. And I try and stay away from just the being an absolutist with some of this advice. So the one thing I do know is that I'm sure you and I would both agree we want to help our clients pay as little in tax as possible, but
Sure.
pay what you're legally required to
Yeah.
pay. And that I think is something that we can all agree to, but it's going to look different from family to family. And that's part of the enjoyment in planning, but it is also the part where we do have to constantly be re-educating ourselves and making sure that we understand the changes that are taking place. But yeah, very very well said on your part because that's I think what we're going to continue to see, regardless of that's the one constant we know will happen is change.
Yeah, always, always. Um, so Dan, if people are looking to learn a little bit more about student loans, the best way to work ahead of time or past time on managing the cost of college, what resources do you have available, and what resources do you see coming up here in the future?
Yeah, well, appreciate you asking. The best place you can find me is at www.thecollegedude.com. So there's going to be some maintenance, I would say, to the website upcoming, but we did also take a brief break on the on YouTube creation, but we also have our own YouTube page. It's at the College Dude that you can find the videos we put out there. But between having another baby and just some other personal things going on, kind of took a brief pause on that. But we do our best to make sure that the content that we're putting out there is easy to understand and bite sized for folks. That it's not. It can be a complicated landscape. We do our best to try and speak it in plain English. But certainly between the website and the YouTube channel, those are places that you can find some content and make sure that your plan is designed to help you. but it's definitely something that, like I said, is since it's constantly changing, we do our best to try and stay up to date on that and make sure that families understand the changes that are upcoming.
Yeah, yeah, and if you're a listener that has questions around it, feel free to get in contact with us at the Leonard Advisory Group. If you're already working with us, Dan and I have talked about ways to work together with clients. So if you are one of those clients nearing retirement but looking at paying down some student loan debt, maybe a consult with the college dude is helpful for you as well. So we're happy to work together there. I met Dan over a year ago at a conference, and
Mhm.
it's great to build friendships in the industry and be able to hopefully make the financial landscape better for all of our listeners and members of our community. So, Dan, thank you so much for coming back on today and sharing your wisdom. Any parting thoughts or any other key takeaways that you had while studying for the CSLP?
Well, first off, thank you for having me again, Josh. It's always a pleasure to catch up with you, and continued success for your podcast and your practice as well. But no, I would say the again we covered pretty much the majority of what it is. I think it's again the biggest takeaway that I have is student loan debt. It causes a lot of despair for folks, but again, just as you help families do, and certainly we try and do our best with that, is just to provide them hope and showing them how they can get out of it. But it does require some work on the front end and on the back end too for clients that we work with. But just want to try to reiterate the fact that not all hope is lost in this situation. And again, just want to again thank you for taking the time to go through this today, because it's an important topic.
Yeah, well, I certainly appreciate you coming on, and I'm sure as the landscape changes, we'll have you back on to share some of your insights here. And thanks again for listening, everyone. Make sure to give us a 5-star rating and like and subscribe to the podcast. Until next time.